Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Monday, February 25th, 2019. This one will be short, that I promise. Not a lot to report, but some developments definitely worth noting. I did do an update in pre-market today, which I'll be doing more often. Just a screenshot of some of the charts I'm watching. That one was, we had a couple premium content items in there, nat gas, crude oil, things like that we've been watching as well, some developments. But in the update I mentioned in the pre-market session, SPY had just hit this line here. This is the going back to highlighted that recently, going back to my December 31st year-end outlook video. Wrapping up 2018. At the time, that was mentioned as my uppermost bounce target. I had a bounce target range, a minimum target. This blue line down here. That's where we peaked at right around, give or take, around that first where the momentum really tapered off, if you will, after was it January 18th. Anyways, so this was the uppermost target, and that line has been hit pretty much to the exact penny today. You zoom in here, and that's technical analysis. Never fails to amaze me. Now, listen, this is a reaction so far, and a minor, relatively minor reaction. I define a reaction as when you have a trend coming into a support or resistance level. A reaction is pause and or consolidation, or a reversal, I should say, not a consolidation or reversal off that point. So as you can see, we reversed, and you zoom in real tight, and you can see that I have not modified this trend line since then. It's right there. Anyways, so time will tell whether we're going to go through that or not. So every tick above there, it's exceeding my uppermost expectation. As I mentioned, one of two things usually happens. Now it'll probably prove me wrong again, but I say usually if all eyes are on a level, you either reverse just shy of that level, if all eyes are watching it, or you punch up through and then reverse. So there's still, like I said, when you're talking a move of this magnitude here and this kind of velocity, 1, 2 day move, a couple days above there, as long as we don't really put it in the, far in the distance, like, moving out up here, pop above there really isn't going to do a whole lot on the chart. As far as taking out that resistance level. In other words, it would be normal to have a momentum fueled overshoot. You have a lot of velocity or upside momentum coming into that level. We hit it today, had a little pullback. So let's see. We'll leave it open, and keep in mind, yeah, once you get much above that level, not only is it very significant resistance, but you also have the previous highs right here, the all-time highs, and it's just almost natural behavior when a security gets close to its all-time highs that it'll want to make a run at those highs, even if it won't hold. So the closer you get there, I kind of use the analogy of like a black hole. Anything that gets close to it, even light doesn't escape; it gets sucked in. You have those highs like that. If we get a lot closer, we'll probably run them. So I'm still favoring this scenario, and if the market starts to prove me wrong here, then we're going to come up, and chances are the market will want to make a run at those previous highs. Okay, quick look at the 60-minute charts. This is SPY. I'll start here with the index ETFs, and we'll look at the futures. Similar story, of course. There it is. It's a nice clean trend line off that low. I'm focusing more so on the reaction low on the 27th and that on the 24th, although they both come in around the same level. And we're really just compressing within this wedge. We continue to inch higher. Momentum is slowing. Market's going up, but it's losing steam on the rally. And we still need to see a break of that level, and then I think as importantly, if not more importantly, also take out Thursday's lows. I mentioned that the other day. We have that reaction low on both SPY and QQQ, or I'm really focused on the futures, NQ and ES. We'll get to those in a second. So there's what SPY looks like on a 60-minute time frame. Something worth mentioning too, on the daily charts, we had gaps today. The index ETFs gapped up. So that leaves a potential. Actually, a member of the site had pointed that out and asked me about it on QQQ. Does it set the stage for a potential island top? Certainly. Anytime you have, especially at this point, we had some gaps early on that would be a continuation. We had a continuation gap around right here. So, so this one has the potential to be an exhaustion gap. Those are the gaps that come at the end of a run. We'll see. But again, the thing about those type of gaps, we're going to look at it on QQQ as well. It shows a little clearer right here. You can see the gap. island tops and island cluster tops. An island top is when you have a single candle at the end of an uptrend. And you can also have an island bottom as well after a downtrend. But in this case, you have a candle separated by a gap. Now it's only a potential island candle. There's, every time you gap up, there's that potential, but only number one, after an extended run, because island tops are reversal topping patterns. They're not any type of quick pullback trading patterns. Sometimes they might play out that way, but by definition, they come at the end of an extended run and mark a pretty key inflection point. But what you need, of course, the gap is just part one. So it's only a potential setup. But if we gap down tomorrow, that would leave an island, especially if we close there. So I like these. Are one of my favorite trading patterns because the risk reward is tremendous. If you look at it this way, so tomorrow, for example, if you gap down, there's two ways to trade it. You can short a gap down, or short if that gap down has a kickback rally that comes to backfill the gap. Because as you guys know, very often if securities or the security or the indexes gap down, they may want to run it top, make a backfill of the gap, and then go back down. So let's just say it, keep it simple. Maybe a half a position short on the gap down, another half a position on the kickback to the backfill of the gap with a stop above yesterday's highs. Where does that leave you? Obviously, it depends exactly where we cap down, but let's just say let's say you get a short at the backfill of the gap here. Let's say somewhere around here. So yesterday's highs, I'm doing the measuring tool there, 0.73%. So let's say you give it even a little room to pop above the top of yesterday's highs. Let's see if my measuring tool is working. There it is. Yeah, so you could say 0.8489, 0.9%, maybe 1%. That's your maximum loss. That's your downside. And your upside potential. And again, this right now, I think there's people, if you have an opinion on the market, there are people that aren't sure what to do, and that's fine. When you don't have an opinion, stand aside. But there's those that think that we're off to new highs. Another roaring bull market in 2019. We're going to take out the previous highs and then some. And if so, then and I'm sure those are looking at least for a pullback right now to either add some new longs, or maybe they've taken profits or looking to do so and want to go back in. So my point here is you can either target pullback, and I still think, just looking at this chart, I think 166.50ish, that's a pretty decent target. So let's say on the gap down you get it there. You could ride a short down or hold off if you don't short. And you don't want to short against this trend. I understand that. Some people don't. But you're looking at about a 4% pullback. So then short could either cover there. So that's a 4 to, what is that? About a 4 to 1 RR. That's a very attractive risk reward. And then there are those on the other side that believe that, and I know that it's a minority now, of a pretty small and quickly shrinking minority, but those that believe that this rally may prove to be simply a bear market rally, with this being the first leg down in a new bear market to come. Now, that in that case, again, you're looking at a less than a 1% loss if stopped out to my targets. They go off this chart, but let's just say they're well beyond a 20% drop between current levels. So that is an insane risk reward. And you can look at it this way. Okay, so even if you say, Randy, okay, that's a possibility. You have to acknowledge anything in the markets is possible, but the probability is very slim. So you're taking a long shot. It's like going to the races and betting the horses. You have you take a long shot. You're probably not going to win the race, but if you hit it, the payoff's big. And it all comes back to how much money. If that's what you're going to take that trade, is put the amount in that you're willing to lose. Calculate your risk reward. And again, you can do that by using our new trade position size calculator on the right side of the chart. Just come into the site. This is available to all public content. Click on the little calculator icon. You have one here that it will help you determine how much of your portfolio, how much you want to put at risk on a trade as a percentage of your overall portfolio. Big, very important. If you're not sure what you're doing, keep that in mind. Probably stay. It's generic, or I should say, it's not generic. It's dynamic. It depends on every investor, every trader. But for safe part on a swing trade, let's just say 1%. That's why I have that as the default number in there. You can risk 1% of your portfolio on a trade. And of course, again, that can vary. Or if you know how much you like to put in per trade, you trade $50,000, you trade 5,000, doesn't matter. Just put in your position size here. So again, that will give you the risk reward ratio and what your total gain or loss would be on that trade. Okay, and then moving on to QQQ, 60-minute chart, same trend line off the lows on the 27th. A lot of reactions, wedge I've been talking about recently. That broke down last week. So today we had a kickback, back test, I should say, of the wedge. A little kickback rally, back tested the wedge. Remember, I've talked about this in recent videos, divergences, my upper line on a wedge. It's a little different with a parallel price channel, but on wedges, whether they're bullish falling wedges or bearish rising wedges like this one, the divergence lines are not a trend line. They can be moved up because the security's in an uptrend. As long, they're just showing you the divergences against the indicators with prices making higher highs, whether that line moves up like this. This is the important line. This is the one we watch because you have a lot of reactions on the trend line. So there's a breakdown back test. And one more, I want to cover IWM. Okay, here's what the small caps look like. They had a pretty hard intraday fade. They went red for a bit, closed about flat, up 0.03. That trend line I am using off the lows on the 24th. It comes in pretty clean with the recent reaction high, so that's what stands out. Those are potential targets down there, areas that we're likely to have a reaction if and when it gets there. And this is the bigger picture. Price is wedging up, and again, same story. Some divergences building and getting a little steeper here on the most recent advance. So sell signal still pending on IWM at this point in time. And finally, to conclude here with the futures, NQ, the NASDAQ 100 futures. I showed you a minute ago the breakdown and back test on QQQ. Likewise, that's what we've had here. Same story, coming off the lows on the 27th as our trend line. There's our wedging action. There's the divergences, which were extended with today's highs right there. Confirmed PPO has made a bearish cross, but again, we need to see ES, SPY, and QQQ all break down, and I also want to see, as I've stated before, that low, that reaction low. I think that would really open the door right there. The reaction low from last Thursday to a pretty impulsive move down. So we'll see what happens. But again, these are all potential targets right now. We'll look at these. And finally, the takeaway is, again, if you are bullish looking to buy a pullback, then what I can tell you with a pretty high degree of confidence, that level right there, and it would be pretty sizable if we got it. It would be a drop of, I'd have to pull out a measuring tool, but it would be a pretty decent pullback and certainly an objective area to go long. And keep in mind, you'd be coming in around the same time on some key moving averages. And when we flip back to the indexes, we could come in and back test 250. So there it is. They're tuned down here a little bit. I'll turn those up where you can see those. The 200. This is the 200 exponential moving average, and the 50-day exponential moving average. You can put up the simple moving averages. They're similar, but they'll come in at different levels. So maybe a pullback would also look something like this. So whether you're looking to buy a pullback to a dip, I think that's a pretty decent level to be targeting, a rough level. And of course, if you are putting on shorts, you're already short, and you're looking for a bigger move down, then if we get a sell signal soon, you put a stop above the highs, and it might look something like this. There might be a bounce there, or there might not. One thing that we'll have to look at is the nature of the pullback, and I can say this with a pretty high degree of confidence that the lower we go, everyone's expecting a pullback, and people will be buying the first dip, and shorts will be covering the first dip. But the lower we go, once we start taking out levels that should contain pullbacks, I truly believe that will open up waterfall type sell-off. I think there were a lot of people that got trapped here. They didn't get shaken out. They're getting back close to where they were. Those people sell. The people that bought will probably soon be taking profits. And so somewhere in this range, I expect the pullback and the next pullback, if it gets down this far, of course, I'm assuming, to be somewhat orderly. I mean, there might be an impulsive day or two in there, a couple days, but if we start to even get close to these lows, I just think the floodgates will open. That's what I suspect. But again, let's take it day by day, week by week. Right now, let's just see what happens tomorrow. We still don't have the any high probability sell signals yet. And finally, we'll wrap it up here. The S&P 500 futures, ES, same story, coming off the lows on the 27th. Just a pretty clean trend line. We had a little whipsaw signal last week, but then again, that's that low, that reaction low. We need to undercut now. Last Thursday's low, and like I said, we just continue to really pinch higher within this wedge. And, if we go up a lot more from here, then guess what? We've taken out on this 60-minute chart, we've taken out those divergences. We've also taken out that resistance level that I talked about in the beginning of the video, those 3 reaction highs back from last fall. And that just will continue to chip away at the bearish case. So we'll wrap it up here, see what happens tomorrow, and if anything, anything significant happens, I'll do a video update. Otherwise, if it's status quo, I'll just put up some charts on the site. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.